All right, so we're diving back into KIPPRATE.
Okay.
Remember our last deep dive where we kind of explored their whole community mall focus and how they were really doing well in that space?
Right.
Well, their Q2 FY 2025 report just dropped.
It did.
And there are some really interesting developments that we need to unpack today.
Yeah, for sure.
Awesome.
This is quite a bit to go over.
Buckle up, everyone.
Yeah.
One of the things that jumps out right away is that dividend drop. Remember that nice payout last quarter?
Yeah.
This time, it's significantly lower.
Right.
What's the story there?
So what happened was they actually made a strategic move by issuing a large advance income distribution back in November.
Oh.
So this was basically to avoid getting hit with a bigger tax bill in 2025.
Okay.
So it's not necessarily a sign of trouble. It's more like a financial maneuver.
So clever accounting.
Exactly.
But the question is, can they keep up those dividends in the long run?
Yeah.
Especially with their ambitious growth plan.
That's the million-dollar question.
It is.
To answer that, we really need to look at the whole picture.
Okay.
So let's start with the revenue.
Okay.
They reported a 32.7% jump compared to last year,
Wow.
hitting RM 30 million for the quarter.
That's pretty impressive.
It is. Yeah, it's a big jump.
But I'm looking at their net profit, and it actually dipped.
Yeah.
That doesn't really add up, does it?
Well, you're right to question that.
Okay.
While revenue is soaring, their operating expenses have also climbed by 32% year on year.
Oh.
So think utilities, maintenance, marketing, all those costs that come with expanding your operations.
So it's kind of like growing pains then.
Exactly.
It's like, but are there any other factors contributing to that dip in profit?
Definitely. Their management fees and borrowing costs have increased too.
Okay.
And you know those industrial properties they recently acquired?
Yeah.
Well, they finance those entirely through bank loans, and that's pushing their gearing ratio higher.
Gearing ratio.
Yes.
I don't speak fluent finance, so could you maybe break that down for me?
Of course.
And our listeners.
Yeah, so gearing ratio is basically a measure of how much debt a company is using compared to its equity.
Okay.
So a higher gearing ratio basically means they're using more debt to finance their assets.
Okay.
In KIPPRATE's case, it's now at 45.23%.
And that's a lot.
It's getting up there.
Should we be worried?
Not quite panic button territory yet, but it's definitely something to watch.
Okay.
You know, the regulatory limit for REITs is 50%.
Right.
So they're getting pretty close.
Okay.
But the good news is they seem to be aware of this risk.
Okay.
They're managing their debt so that loans mature at different times, and they're exploring various financing options to sort of mitigate that risk.
Okay, so they're not just burying their heads in the sand.
Exactly. They're being proactive.
But with all this debt and expansion, how are their core assets actually performing?
Well, overall, their malls are doing well.
Okay.
Occupancy rates are averaging around 90%, which is a healthy sign.
That is good.
For example, KIPPRATE Malbangi just went through a major renovation, and their occupancy jumped to 83.9%.
Really?
So they call it an asset enhancement initiative, and it seems to be paying off.
So they're actively investing in their properties to attract and retain tenants.
Exactly. They're not just sitting back.
That's a good move.
They're making things happen.
But even with this strong occupancy, we need to consider the bigger picture.
Yeah.
What's the overall financial health of KIPPRATE looking like?
Well, analysts have given them a score of 7 out of 10.
7 out of 10.
Which sounds
That sounds pretty good.
pretty decent at first glance. Yeah.
What's the story behind the score?
Yeah.
What are the strengths and weaknesses they're seeing?
So on the positive side, their high occupancy rates and efforts to control costs are definite strengths.
Okay.
They're managing their existing portfolio efficiently.
And the not so good news.
Well, there are concerns about pressure on rental growth,
Hmm.
due to competition.
Makes sense.
The retail landscape is constantly evolving, and keeping those rental incomes steady is a challenge.
Okay.
Another concern is the potential impact of rising interest rates.
Right. Because of all that debt.
Exactly.
Yeah.
All that debt we talked about.
Yeah.
Higher interest rates mean higher borrowing costs, which could eat into their profits.
So it's a bit of a mixed bag.
It is.
High occupancy and efficient management are good.
Yeah.
But those rising debt levels and potential interest rate hikes,
Right.
definitely factors to keep an eye on.
Absolutely. And that's why it's so important to dig deeper into the details of their financial performance.
Okay.
It's not just about the headline numbers.
Right.
It's about understanding the nuances.
I completely agree. So let's keep digging.
Okay.
What other insights can we unearth from this report that will help our listeners make informed decisions?
Well, one intriguing development is the Employees Provident Fund, or EPF, increasing their stake in KIPPRATE.
The EPF.
Yes, they're a major player in Malaysia known for their long-term investment approach and rigorous due diligence.
So this sounds like a pretty big deal.
It is.
Is this like a vote of confidence from a seasoned investor?
It's definitely a positive signal. While we can't say for sure what their motivations are, the EPF's involvement suggests they see potential in KIPPRATE's ability to generate consistent returns over long haul.
Interesting.
Yes.
So KIPPRATE seems to be attracting the attention of some heavy hitters.
They are.
Well, what about their own ambitions?
Yeah.
Remember those aggressive growth targets they set?
You're talking about their goal of reaching RM2 billion in assets under management?
Exactly.
That's a bold target.
Yeah.
And how they achieve it will be crucial.
We've seen they're not afraid to take on debt to fuel their expansion.
Right.
But is this sustainable? Could it all come crashing down?
That's a question we'll explore in more depth as we continue our deep dive.
Okay.
Stay with us because things are about to get really interesting.
I'm intrigued. So we've established that KIPPRATE is on this ambitious growth trajectory.
Right.
But they're also walking this tightrope with their debt levels.
Yeah.
So how exactly are they planning to hit that RM2 billion asset target? Is it all about snapping up more properties?
Acquisitions are definitely a big part of their strategy,
Okay.
but it's not just about buying any property.
Right.
They're focusing on assets that align with their overall vision.
Okay.
Remember, they specialize in community malls,
Right.
those everyday shopping centers that cater to the needs of local residents.
Right. The grocery stores, pharmacies, those essential services that people need.
Exactly.
So are they sticking to that community mall model for their acquisitions?
They are, but they're also branching out a little
Uppers,
into industrial properties.
Okay.
They now own 6 of them.
Wow.
And this segment is a strategic move,
Okay.
considering the current growth in logistics and warehousing.
Oh, that makes sense. With e-commerce booming, those sectors are becoming more vital.
Exactly.
So KIPPRATE is diversifying its portfolio,
Yes.
which seems like a smart way to spread the risk.
It is a way to mitigate risk, for sure.
But you mentioned the retail landscape is becoming increasingly competitive. So how is KIPPRATE ensuring that those community malls stay relevant and attractive to shoppers?
Well, that's a really good question, and it's one they're clearly addressing.
Okay.
You know those asset enhancement initiatives we talked about?
Yeah.
Well, those play a crucial role in keeping their malls fresh and appealing.
Okay.
You know, it's not just about renovations. It's about creating a more engaging and experiential shopping environment.
So giving people a reason to actually go to the mall,
Exactly.
not just order things online.
Yeah, give them an experience.
Yeah.
They're incorporating more dining options,
Okay.
entertainment venues, and social spaces.
So it's kind of like they're creating a sense of community,
Exactly.
encouraging people to spend more time
And hopefully more money.
at their malls.
Right.
Makes a lot of sense.
Yeah.
But let's circle back to those dividends.
Okay.
We know they dipped this quarter due to that strategic payout maneuver.
Right.
But what about the future?
Yeah.
Can they maintain a consistent dividend payout,
It's a balancing act.
especially with all these acquisitions and rising debt?
Right.
It feels very precarious.
It is, remember, those acquisitions, while strategically sound,
Yeah.
are largely funded by debt.
Right.
This means they need to ensure those acquisitions generate enough income
Yeah.
to cover the debt servicing costs and still leave enough to distribute to unit holders.
So it all boils down to how effectively they manage those acquisitions.
Exactly.
Make sure they're truly adding value.
Right.
And of course, those pesky interest rates can always throw a wrench in the works.
Oh, absolutely. Higher interest rates could increase their borrowing costs
Right.
and potentially squeeze their profit margins and affect their ability to pay out those attractive dividends.
Right.
So it's a delicate situation
It is.
and one that investors need to monitor very, very closely.
It seems like KIPPRATE is playing a bit of a high-stakes game here.
A little bit, yeah.
On one hand, they're making these bold moves to expand and diversify their portfolio,
Yeah.
which could lead to significant growth in returns. But on the other hand,
They're taking on more debt,
they're taking on more debt.
which always carries an element of risk.
It's a classic risk-reward scenario.
Exactly. And this is where that 7 out of 10 financial score becomes really interesting.
Okay.
It reflects both the potential and the challenges that KIPPRATE faces.
So how should our listener interpret that score? What does it really tell us about KIPPRATE's prospects?
Well, it tells us they're in a decent position,
Okay.
but not without vulnerabilities.
Right.
They've got some strengths working in their favor.
Yeah,
But those risks we've been discussing are real,
they are.
and they shouldn't be ignored.
So what should investors be paying close attention to as they evaluate KIP rate?
Hmm.
What are the key factors that will determine their success or failure in achieving these ambitious goals?
Okay, well, first and foremost, they need to keep a close eye on KIPPRATE's debt management strategy.
Okay. Debt management.
Are they effectively mitigating the risks associated with their rising gearing ratio? Are they finding ways to optimize their capital structure and reduce their exposure to interest rate fluctuations?
Okay. Debt management is crucial.
It is.
What else should be on investors' radar?
Another key area to watch is their acquisition strategy.
Okay.
Are they acquiring properties that are truly accretive?
Okay.
Meaning they add value and generate sufficient returns to justify the purchase price.
Right. So it's not just about buying more properties.
Yeah.
It's about buying the right properties
Exactly.
and managing them effectively.
You got it.
Okay.
And finally, investors need to keep a pulse on the broader market environment.
Okay.
The retail landscape is constantly evolving and competition is fierce.
So how is KIPPRATE adapting to these challenges?
Hmm.
Are they just riding the wave, or are they actively shaping their future in this dynamic market?
That's a question we'll delve into as we continue our deep dive.
Okay.
Stay with us as we explore how KIPPRATE is navigating the changing tides of the retail industry
All right.
and what it means for their long-term prospects.
Sounds good.
Yeah.
So we've talked a lot about like the financials,
Yeah.
and their plans for growth, but
Right.
let's not forget about the human element here.
Yeah, that's important.
These malls aren't just buildings and balance sheets. They're part of communities.
They are.
So how is KIPPRATE adapting to the changing needs and expectations of the shoppers in those communities?
I think that's a crucial point.
Yeah.
KIPPRATE really understands that in today's world, malls need to be more than just places to shop.
Yeah.
They need to be destinations offering experiences.
Right. It's about creating a sense of place,
Exactly.
a reason to actually like go to the mall instead of shopping online or
Yeah.
going to some other,
Right.
entertainment option.
Yeah, they really want to bring people in and give them a reason to be there.
Yeah. So how are they doing that?
Well, their asset enhancement initiatives,
Right.
which we touched on earlier, are a big part of this.
Okay.
They're investing in renovations and upgrades that transform their malls into like vibrant community hubs.
So what does that look like in practice?
Okay, well, they're incorporating more dining options,
Okay.
from casual eateries to like trendy restaurants.
So a wide range.
Yeah, catering to a wider range of tastes and budgets.
Okay.
They're also adding entertainment venues like cinemas,
Okay.
arcades, and even fitness centers.
Wow.
Things that appeal to families and individuals looking for those leisure activities.
So it's really about like creating this,
It's about creating a more well-rounded experience.
this experience that caters to so many different
Yeah, caters to a wider variety of needs and interests.
needs and interests, and making the mall a place where people want to spend time,
Exactly.
not just like run in and run out.
Right. It's not just about transactions anymore.
Yeah.
It's about the whole experience. And
Yeah.
they're not stopping there.
Okay.
They're also creating more inviting and engaging social spaces within their malls.
Okay.
Think comfortable seating areas.
Like a place you could just hang out?
Exactly. Interactive displays and even outdoor spaces
All right.
where people can relax and connect.
It really sounds like they're putting a lot of thought and effort
They are.
into the customer experience.
Yeah.
But let's not forget their foray into industrial properties
Right.
with all this focus on community malls and experiential shopping.
Yeah.
How does that fit into their long-term strategy?
Well, it's all about diversification and capitalizing on emerging trends.
Okay.
The industrial property segment,
Yeah.
particularly logistics and warehousing, is experiencing significant growth.
Right.
Thanks to the rise of e-commerce.
Yeah.
KIPPRATE is strategically positioning itself to benefit from this trend.
So while their core focus remains on these malls,
Right.
they're not afraid to explore other avenues for growth.
Exactly. They're adapting.
That's smart.
Yeah, to the changing dynamics of the real estate market.
Right. And those industrial properties are generating good returns,
They are. They're contributing to their overall financial stability.
which helps to offset some of the concerns about their retail portfolio.
Exactly. This diversification helps mitigate some of those risks.
Right. It's about having a balanced portfolio that
Yeah.
can withstand anything,
Right.
economic fluctuations or shifts in the industry.
Yeah, exact.
But all of this expansion and diversification,
Yeah,
it comes at a cost.
it does.
Their debt levels are a concern,
Mm.
and interest rates could really throw a wrench into everything.
Yeah, those are definitely factors to consider.
So what are they doing to address these concerns?
Well, it seems they're taking a proactive approach.
Okay.
They're actively managing their debt maturity profile,
Okay.
spreading out their repayment obligations.
Okay, so they're not putting all their eggs in one basket.
No, they're trying to avoid a sudden cash crunch,
Right.
and they're also exploring different financing options
Okay.
to optimize their capital structure.
So it sounds like they're taking the necessary steps,
It seems so.
but it's definitely something investors need to keep an eye on.
Absolutely. Debt management is an ongoing process, and KIPPRATE's success will depend on their ability to navigate these financial complexities.
We've covered a lot today, from KIPPRATE's financial performance and business model to their adaptation strategies and risk management efforts.
We have.
So what's the bottom line?
Hmm.
What are the key takeaways that our listeners should be considering when evaluating KIPPRATE as a potential investment?
Okay. Well, first and foremost, KIPPRATE is a company in motion.
Okay.
They're ambitious, growth-oriented, and actively adapting to the changing retail landscape.
Yeah.
Their focus on community malls provides a degree of resilience,
Okay.
and their expansion into industrial properties offers diversification.
But as we've discussed, their rising debt levels and aggressive acquisition strategy are factors that require careful consideration.
Absolutely.
Investors need to weigh the potential rewards of growth against the inherent risks
Right.
and make sure Capri aligns with their own investment objectives and risk tolerance.
That's a key point. It's really about understanding your own needs and goals.
Right.
As an investor.
Ultimately, the decision of whether or not to invest in KIPPRATE is a personal one.
It is.
There's no one-size-fits-all answer.
Exactly.
We've provided you with the information and insights.
And hopefully some things to think about.
Now it's up to you to weigh the pros and cons and make an informed decision that aligns with your financial goals.
And remember, the world of investing is constantly changing.
It is.
Stay informed, do your research,
Yes.
and never be afraid to ask questions.
Great advice. Thanks for joining me on this deep dive into KIPPRATE.
It was my pleasure.
And to all our listeners out there, happy investing.